Welcome to another quick stock analysis, and today I'll be looking at Rockwell Automation.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
Welcome back everyone. Today I'm
going
going to be looking at Rockwell Automation by popular request. Rockwell Automation, just looking at their website, is a robotics company, lots and lots of different products. Just looking at this company is exceptionally interesting. There's tons of really cool stuff that they make, and I can see this as another sort of Cathie Wood robotics, future robotics play going on here, particularly for automated machinery and in-store stock picking, that sort of thing. We can see a lot of this happening in the future, and you can probably already guess that this company might just have a little bit of hype behind it right now. Looking at the chart since March 2020, we've had an 80% return. Very good, but obviously we've had a lot of exuberance in the past couple of years, or in the last year at least. And like a lot of the other stocks where Cathie Wood has had her little golden touch on them, I'm not actually sure if this is in an ARK ETF at all, but it looks and sounds exactly like something Cathie Wood would be going for right now. Like those stocks, the price has shot up massively since March as we head into the new world and we start to think that everything is going to be robotics and genomics and clean energy. Just a reminder, when I'm valuing a stock at this 500-foot level, I'm really zooming out on this stock. I don't know anything really too qualitative about it. I don't know what the actual industry is doing right now. I'm simply looking at the stock from a fundamental basis, and I look at 5 things when I'm looking at this fundamentals. I'm looking at revenue growth, I'm looking at EBITDA growth, I'm looking at justifiable debt, I'm looking for free cash flow, which is, I think, is the most important. I want a company to be earning some cash and being able to pay back to shareholders in the forms of buybacks and dividends, whatever you want it to be. And then I'm going to look at analyst forecasts, and then finally I'm going to try and come up with a valuation that I realistically would want to pay for this company. A great one to look at first with many stocks is if they can pay off their short-term liabilities, and I look at this through current ratio, and currently the current ratio for Rockwell is 1.48, which is surprisingly low, to be honest with you. I mean, it's above 1, so it can definitely pay off its debts, but 1.5 is kind of just a little bit too close to essentially being bankrupt, really. So that's a very important thing just to remember there. Shares outstanding was one of the most important things that I thought was really cool about Rockwell. It's got a considerably good share buyback program, which is delivering a lot back to shareholders. Quite like that in a company. The problem can arise when the company is starting to take out a lot of debt in order to raise its EPS, its earnings per share. So a lot of CEOs in these companies and even CFOs, their pay is linked directly to what their EPS is. And it's very easy to fudge the EPS by buying back shares. It's one reason I really don't like buying back shares over dividends, because there's a lot more of the ratio fudging that you can do when you buy back a lot of shares, especially at a ridiculously high price. And one thing I will say about this share buyback program right now is I don't understand why these shares have been bought back when the price is quite exuberant at the moment. It tells me that they're only really buying it back for the sake of it. And with share buybacks, I don't think that's a really good use of a company money. First, I'll look at revenue growth, and to be honest with you, you have to go back 15 years before you start to see a good revenue growth trend. Going back 10 years, it's still going up in general, but there is quite a flatness to this revenue growth at the moment. It's only growing its revenue at 3%. That's very interesting for this company, considering it's quite an exciting robotics, switches, motor-driven sort of company. And over the past 5 years, it's been dead flat. Past 5 years of revenue for this company have been 0.2%. So this company, especially its products, don't seem to be growing at the moment. Next, I'll take a look at EBITDA growth, and this does look a bit better, but not significantly better. 6.6% EBITDA growth over the past 10 years, and over 5 years, dead flat. even -9, you could say there. So again, this company isn't growing its profit. It isn't growing its profit margin. There's a lot of little worries here, only yellow flags. They're not severe red flags, but there's nothing about this company, even though when you look at their website, it's so exciting with all the robots and all the switches and everything it might do in the future. This company isn't actually making any money, and it's been around for quite a while. And total debt is only growing. Now, this could be seen in many different ways. You would have to say that, yep, it's very easy to take on debt at the moment because there's low interest rates. So any reinvestment is really going to be good here. But they are buying back a lot of shares. They have a dividend of about 1.5%. Don't really care about that because that's kind of a constant payment. But when you're buying back shares at ridiculously high prices, that suggests that there's a mismanagement of funds there, and I don't understand why you'd be taking out debt in order to do that. You just keep your dividend flat, you just keep your share buybacks flat, and then when better times come around, or everything's caught up, then that's when you'll start putting back some share buybacks. This just seems a little bit counterintuitive to me, especially when you look over the last 5 years of free cash flow and they haven't been growing it. So I haven't checked the dividend growth yet, but if you're growing your share buybacks and paying a lot more to buy back some shares, I don't understand why you would do this when you haven't got any free cash flow growth. It's a bit of a shame because this company, as I first looked at it, and I looked at the website and I looked at it, a little bit of news on it as well, I thought, wow, this is an exciting company. And it probably is for the future. Qualitatively, this might be a really good company going forward. It's got that Cathy Wood storyline to it, maybe a really, really good robotics play. But to be honest with you, at the moment, not really making any money. And you can see it on the graph. You can see it right here that, it's been going through a pretty exuberant period. A lot of people are very excited about this company. I'd love to find out if it's in the ARK ETF. Let's have a look. So it does look like it's in ARKQ, the autonomous and robotics technology. Pretty good. So that's why it's been getting a lot of hype recently. Forecasting wise, this is what the analysts think. We've got analysts of 25, 25, 13 and 4. That's how many analysts are looking at this company and how many have guessed. And they pretty much are making guesses at how good this company is going to grow in the future. So 25 analysts, an average sum of those think that it's going to grow at 16% next year. It's going to grow 7% the year after, 8% after that, and 10% in 2024. So analysts do see this company growing. They see it growing at 10% a year, even though it hasn't done that for about 5 years. But who am I to go against them? And that's why we do these things. So at least it's got that going for it. At least a lot of analysts really do think that this company is going to grow quite a lot over the next 4 years. Now, to find a valuation on this company, I want to figure out exactly how popular it's going to be come 2026. And quite rightly so, because it is a very exciting company. Rockwell Automation does trade at about a 22 PE historically. And what I'm taking right now is an average of 8% growth year on year, which is a pretty good situation, I think, especially in comparison to what it has been. So if we were to consider an 8% growth year on year at a 22 terminal multiple, and remember the multiple at the end here, these little bits here, all this line of 33x and 21x, this is how much investors might consider this stock to be worth in 2026. So an average PE would normally be about 15. So AT&T, that would be a company that generally trades at a 15 PE and lower because it's not a particularly high growth company. It's not a particularly popular company. It's just a company that trades at a PE of 15. Really exciting companies can go as much as sort of 30 PE. And then obviously you've got your ridiculous companies which start trading at thousands and thousands PE. Those are very, very speculative growth companies. What we're looking at here is not a very speculative growth company. It is a growth company, but it's not particularly speculative because it's got a great product. It has a really good industry, and there are a lot of tailwinds coming for this company. So in 2026, if we consider that this company grows at an 8% year-on-year average and it ends in a PE of 22, we can expect the share price to be $275, which is only $5 up from its current price of $270. That is a 2.28% year-on-year return. That's including the dividends as well. So this is something that I consider as a normal case scenario. This is what the analysts think. This is what the experts think. And this is where this company is probably going to go. However, let's say that Rockwell Automation goes really good. Things go exceptionally well for it. And we'll say that actually each year Rockwell grows by 15% a year. And also because things are going so well and Cathie Wood is still ridiculously relevant, this company is doing really well. Elon Musk has just put all of its machines on the moon or something like that, or even Mars. And this company now trades at a PE of 30. So this would be the best case possible scenario within 6 years. And in 6 years, we can expect that this company's share price could be around $532. That's 97% up and 14% year-on-year return. That's an exceptional return. Well, it's not that exceptional. It's a return that we should probably expect when we're trying to invest. And then as a value investor, if we've got our value investing head on, we need to figure out what the worst case scenario for this stock might be. So let's say this company doesn't grow at 8% year on year, but it only averages out at a 5% growth year on year. And then I don't think I want to be too harsh. This company does averagely trade at a 22 PE. So I'm not going to put it down to a 15 PE. I think this company is a bit too exciting for it to come down to a 15 PE, but we'll set it at a 20 PE just to find the worst possible case scenario. And in this situation, we can expect the price to be down to $205. Now that's down from $270, which works out at a loss of 23% and a total loss each year of 2.67%. So this is probably a much, much worse scenario than you think it is, because it's great and everything knowing that we might lose 23% on this and we're going to take that risk. And we think, okay, so it's only going to lose a little bit each year. So eventually we'll know about that and we can just sell out and sort of cut our losses. But the problem with this really small 2% year-on-year loss is that you probably won't notice that it's going really, really badly until about 3 years in. And that'll be the point where you've already lost like half of your exposure. While this company is really, really exciting to me and it's a company that I want, I'd absolutely love to buy this company. But at current valuations, the risk is too high. If we're thinking that we want sort of a 10% return, so I'll put it back at a 22 PE and I'll put it back to its 8% year-on-year growth. So we can justifiably expect that this company should be worth around $268 in 2026. And now what I want to look for is a reasonable margin of safety. Now this is a really crude margin of safety. It's not exact. There's a lot more to calculating margin of safety, and this isn't exactly what you would consider a normal margin of safety on a company. But let's say if we wanted to earn, say, a 10% year-on-year return, which is really what we need if we're going to just beat the market. Remember, we're buying stocks because we need to do better than we would in an index fund, because there's no point in going through all this if we could just buy the S&P 500 and that makes 8% year on year, and it's totally pointless, all of this energy that you're putting into it. So if we were looking to make a 10% year-on-year return, I think we need to come down to about $180. So to get 9.61 year-on-year return, this stock, Rockwell Automation, really needs to come down from $270 all the way down to about $180. And according to Fast Graphs, it was about March 2020 when we last saw this sort of $180 mark. So this company, for me, needs to come down between 30 and 40% before I can consider buying it. It looks like it's got an excellent product and it really isn't making much money at the moment, and I don't really know why. Again, this is just a sort of step back view to look at a company as a total and go, right, is this company really within valuation right now, and is it worth buying right now? And for me, no, it's not. It needs to come down about 30-40%. Thank you very much for watching, guys, and if you enjoyed this video, please feel free to like, subscribe, and invest.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.